Hey guys, welcome. Whitney here. I'm going to give it just a minute for everybody to jump in on the Zoom room. If you're like me, you probably had to update your Zoom software in the past couple of hours. So I'm going to give it a minute for everybody to file in. If this is your first time joining, welcome. We do this masterclass every Tuesday, the Passive Investing Made Simple Masterclass, to help you understand all the ins and outs of passive investing so you can go into your next deal with confidence. Now, today I am joined with a very special guest, Scott Marrer with Advanta IRA. Scott, I'm going to give you an opportunity to introduce yourself here in a second. But what I am so excited to talk about in this topic of today just comes out of so many conversations I have with investors. And they think they have full control of their 401k, their IRA, and stuff like that. And really, in reality, you don't. Your IRA is a for benefit of account. And we'll get into a little bit more around what that means. But Scott has a couple of interesting ways for you to really consider, if you've never heard of self-directing, how you can actually bring your investments more into your control. So with that, Scott, I'm not going to give away all the details here, but Scott, tell everybody a little bit about, one, who you are, what you do at Advanta IRA, but more importantly, how you got into real estate.
Sure. Yeah. Thanks, Whitney. I appreciate you having me on. I appreciate everybody joining us today for this session. So yeah, just a little bit about my background. My name's Scott Maurer. I'm the Director of Business Development for Advanta IRA for, almost 17 years now, I think. A little over 17 years. Which we are a self-directed IRA administrator. We're going to get more into that as we go through the topic today. I'm a licensed attorney by degree. I do live in the Tampa Bay area in Florida. This is a little bit on my background. I have, so even though I'm an attorney, I don't give any legal advice. So we're not going to get into any legal discussions or issues really. As part of the presentation today, I do some legal work on the side, but that's a little bit about on my background. So I was, probably as to a lot of the people on the call today, this whole self-directing was new to me 17 years ago. I came into the business, joined our owner at that time was looking to obviously start growing the company. I came in pretty green on even what IRAs were, much less real estate investing. And I just kind of learned trial by fire, just get in and start processing investments. And to be honest with you, I learned the most about real estate from the events that I went to, events like the one that you're hosting today, or some of the real estate investment clubs. I would go out just kind of marketing what Advanta does with IRA accounts, and just have learned from a lot of different people over the years, either hosting our own webinars, being a part of other people's, as well. So I got to the point now where I invest in some syndications myself and look to expand and do some other different things with real estate. Nope, you're muted. Yep.
There you go. Take two. Well, let's dive into the details here, because I've given you the power to, share your presentation. But again, really, I wanted to kind of have this conversation, and that, around, do people really truly realize that when they set money aside for retirement, do they understand that it's technically not their money yet? So I want to kind of peel back the curtain on this, and then we can start getting in some ways to actually put more control in people's hands.
Sure. So that's a great question, because I think you're in control to an extent with your funds. I mean, a lot of people who have, say a 401k through an employer, or even with your IRA, you're in control of, how much you want to contribute, potentially subject to limits that the IRS has in place. You can decide how much money you're putting in on an annual basis, and what type of an account that you want to have. We can go over a couple of those accounts in a little bit. But then as far as what control you're in at that point, it really is going to depend upon who your funds are with, and the custodian that you're either with your 401k or with an IRA account. The custodian you choose is going to likely have limited investment options. So you may be in control to choose amongst what they are allowing you to choose from. But as far as going beyond that into other types of assets like real estate, like syndications, like precious metals, and different things you can hold inside of an IRA account, you really don't have a lot of that control unless you're utilizing, say, a self-directed IRA, or you have a special type of an account like a 401k that we'll discuss a little bit, where you do have much more control over what you can invest in. But for the vast majority of people out there with IRAs, with 401ks, you really are limited by your custodian. So again, you may be technically in control of what investments you're choosing from in that regard, but again, they are limiting you to what they invest in. I have a slide. I'll even kind of jump through part of my content already. It's like going out to dinner. You're in control to choose off the menu, but what restaurant you go to is going to depend on what's on that menu. So you don't have the restaurant there where you can get any possible food you could imagine. But that's what a self-directed IRA allows you to do. So it's similar in that vein to picking what you want to have for dinner that night. You have to find the restaurant that's going to serve the food that you want, and that's what people don't have with more conventional IRAs and 401ks.
Well, and I found myself in a pickle several years ago because I read Tony Robbins' Money Master the Game, and I just got so enamored by all the different options that were out there that you could invest in with your retirement accounts. But moreover, how do you create growth, stable growth, safe growth with certain investments? And my eyes were open, wide open to like just how the Wall Street casino actually works. So anyways, but I like how you described this as a menu, because when I went to my fiduciary, like at our company, our benefits manager, I was like, okay, here's what I want to invest in. And like, here, I'm bringing you my menu. Can I do this? And she was like, nope, here you go. Here are the 5 things you get to invest in. And I'm like, well, that's not what I want. So I'm going to turn you loose here, because I know you have a wealth of knowledge to share with us in probably a short period of time. Guys, if you have questions and you're joining us here live, drop your questions into the Q&A box. That'll help me manage that. And we'll also, again, if you're here live, we will hold some of those kind of like personal situation questions for our what I call our after party section. And anyways, Scott, take it away.
Good. Thanks, Whitney. And yeah, if anyone has questions as they go along, hopefully that, if self-direction is something that's new to you during this webinar, you're going to learn, obviously going to learn a lot of information. But for those of you who are maybe already somewhat familiar with self-directed IRAs, hopefully you're going to pick up a little bit more. And if you have questions specifically, like I said, Whitney, please get those typed in so we can get those answered. Again, here's my bio, just a little bit about me. Here's my contact information. If you're have questions you want to take offline, or something that may be too involved or maybe personal and you don't want to really broadcast it to the group, certainly shoot me an email, give me a phone call. Happy to walk through those questions with you on an individual basis. Just a little bit about our company. We've been around for over 20 years. The only thing we do at Advanta is self-directed retirement accounts. We do not sell investments. We don't give investment advice. We don't do legal or tax services. It's simply administering retirement accounts and people really investing in what we call alternative assets, which will be a little bit more apparent as we go through that presentation today. What really talking about an alternative asset. Practically speaking, and I'm sure many of you on this call are real estate investors or prospective real estate investors. Most of what we do within a self-directed capacity, the assets that we hold for our clients, you can see we have over $2 billion in assets under management. A large, probably 75 to 80% of that is real estate-based investments. Single family homes, syndications, rental properties, things like that. So that's really what we specialize in doing. Again, we're not investment advisors. But again, we'll go through kind of the presentation and really figure out what self-direction is. And again, really how you get control over those retirement accounts. So a self-direction, we use that term, it's not a special type of IRA, it's really a method of investing. So the IRAs that you can self-direct, as you'll see in a couple slides, are your traditional IRAs, your Roths, your SEPs, your solo 401ks. Self-directed IRA simply means that you have one of those types of accounts, but you're able to invest in things under, that you want to. As Whitney already mentioned, I want to invest in something different than what my current custodian is allowing me to do. I want to buy a rental property. I want to do a private loan for my IRA, et cetera. These are all assets really that are outside of the stock market, things that most brokerage firms typically won't hold. And it's not a matter that they can't hold them, it's that they choose not to. It doesn't fit really within their business model. And kind of as we were talking about here, the restaurant analogy, right? So if you go to a particular restaurant, they're not going to tell you about all the things that you could have for dinner that night, but unfortunately is not on their menu, right? They're going to tell you, hey, these are our specials. This is what we do. And maybe you go to that restaurant, you go in knowing exactly what you're going to have that night, or what type of food. And IRAs and
So
brokerage firms a
I
little bit
have
the
a
same way.
question. I have a question on that. Why
Sure.
don't it seems like kind of a no-brainer to me that people like Fidelity, Schwab, if there's an exit, if there's a particular customer that would love to add real estate in some form or fashion to their portfolio or another type of alternative asset,
Mhm.
what prohibits them from having this self-directed arm, and keeping that business there? Like, why not offer it? Like, what's the roadblock for these
The,
companies?
I think the roadblock for them is twofold. One is, anyone who's ever invested in real estate knows, whether you filled out a subscription document for a private placement, whether you've gone through a real estate purchase, there's a lot of paperwork, right? It's a little bit different than just calling up and saying, I need 50 shares of Coca-Cola stock today, and just buy that and be
Can't
done with it.
automate it. Okay.
Right. So the paperwork is much more intensive. They certainly could, and maybe that's really a threat to our industry. I don't see any of those brokerage firms taking this on, but that's one aspect of it. The other aspect is, IRA custodians are required to report annual values each year to the IRS, and for a brokerage account, it's very simple. You see what the account is worth at close of stock trading as of 12/31, and they're done. When it comes to alternative assets like real estate and precious metals and things like that, the values we have to obtain independent values and get valuations from the client to get updates. So it's a little bit more involved in that aspect of it as well. And that's an important part of being an IRA custodian is the IRS reporting. So that's one additional factor. One thing that they would have to do that they don't do currently would be to track down and obtain these different valuations. So for them, I think it's just paper. It's a paper intensive. It's a thing that just, again, doesn't fit within their business model. That being said, I'm sure all of those custodians may hold a few different assets here and there for some clients in an alternative assets division, but for the most part, they are trying to get out of holding any of those assets. So again, most brokerage firms really don't want you to know that you couldn't make these other investment options or make these investment choices, because when you do that, you'll do what all of our clients have done, and that's pull money out of your brokerage account or pull that money out of your CD account at a bank and an IRA and move it to a self-directed account where you could then in turn invest in real estate and other assets. Again, it's going back to my restaurant analogy. They're not going to tell you when you walk in the door, hey, we only serve Italian food. So if you're really interested in some Spanish food, some Greek food, or a steak, you need to go somewhere else tonight. They're not going to tell you that. They're going to welcome you in and show you all the different investments they have. They're not going to tell you what else you could do. And most people who've had 401ks and IRAs, that's where your accounts start. So you really don't necessarily think to ask about other options. You kind of ask what other options you have within that platform, as opposed to asking what else does the IRS allow me to invest in. And you can see that last bullet point that IRS regulations are extremely broad on what you can invest in, but each custodian is not required to hold every possible investment. So that's why brokerage firms stay in their lane and just handle those things that they want to in their business model. And that's why our company handles kind of a lot of the assets in between. People choose to self-direct, I think, for a couple of different reasons. For some people, it's simply just the IRA is providing them with a new capital. So if they're already real estate investors, or they've already invested in, say, startup companies, and they're finding out now they could use their retirement funds to make that same type of an investment. So for those types of clients, the IRA is just another another capital source to make the same investments they've been making on a personal basis. For some clients, it's the stock market fatigue, the ups and downs of the market. We've been seeing that obviously over the last few months. Markets up and down a little bit, hearing different things from different people, and people then get a little scared. I don't really know which way this market's going to go. One person's telling me we're still on the way up. The other person's saying prepare for a huge crash, and they're looking for an asset where they don't have to worry about that. And for a lot of clients, the alternative asset, whether it's precious metals, whether it's real estate that's going to give you a preferred return and cash flow and some appreciation, that makes more sense to them and allows them to at least diversify their portfolio a little bit and not worry as much about the market. For some clients, it is a tax decision. The income The profits you generate from your gains inside an IRA is not taxable to you. Those gains come back into the IRA itself. You potentially will pay taxes down the line when you get to retirement age, but for the time being, the gains just accrue inside the IRA on a tax deferred basis. And so for a lot of individuals who are in higher tax brackets, if they're presented with a really good investment opportunity, let's do that inside my IRA right now so I can just defer the taxes and worry about that down the line. When we're talking about self-directing, it's important to kind of understand, what types of plans could I self-direct? What the monies I have, the accounts I have, what can I self-direct? And it's important to note that any type of IRA, a traditional IRA or a Roth IRA, which are individual accounts. There's also a SEP IRA or SEP for individuals who are self-employed. You can make larger contributions, and we'll cover that in just a moment. We also offer what's called a solo 401k or a QRP, a qualified retirement plan. Again, just a different type of retirement account, again, especially for people who are self-employed or own their own business. And then the other large kind of circle, the large bag of money that people forget about, to be quite honest, are those former employer plans. You work for a company for a number of years, you build up that 401k with them. You have a change of jobs, and in the going through the change of job, starting a new job, maybe moving locations, people kind of forget about that old account that's still sitting there and oh yeah, I forgot I have about 100 grand sitting in an old 401k that I have access to. That money can also certainly be self-directed. About the only restriction when it comes to retirement accounts and being able to self-direct is going to be a current 401k or current employer sponsored plan. If you're working for a company now that's sponsoring your retirement plan, they may have restrictions on you moving that money while you were still employed there. So that's the one area where you might face some restrictions. Other than that, again, any type of IRA, any type of old 401k plan can certainly be self-directed. Just to quickly cover a couple of these at a glance, traditional and Roths, again, are individual retirement accounts. They're smaller annual contribution limits. You do get tax deductions for contributions to traditional IRAs. Roth IRAs, though, are really the, golden child for retirement accounts, because Roth IRAs are actually tax-free investment vehicles. When you contribute money into a Roth IRA account, that money goes in, the IRS considers after tax. You do not get a deduction for it. But the Roth IRA then at that point, because that is after tax money, it grows tax-free as well. So all of the gains that you accrue into that Roth IRA account is actually going to be tax-free money to you when you reach retirement age. So the traditional and Roth IRA is probably the two most common types of accounts that we see. A lot of 401ks are rolled over into either a traditional or a Roth IRA. But again, as far as getting one started and making contributions, the limits on an annual basis are a little bit lower than you'll find for some of the other ones. The other IRA I wanted to highlight, I'm not sure how many people on this call are self-employed, possibly a fair number of you. The next two accounts I'm going to talk about, both the SEP IRA and the solo 401k, are really accounts that you would want to probably look into with your CPA or your tax advisor. These are accounts that are again well suited for self-employed individuals, sole proprietors, people who own their own business. They allow basically larger contributions on an annual basis than you can get with a traditional and a Roth IRA. I'll have a chart for you in just a moment that shows that. So for SEP IRAs, the only drawback is if you do have employees, you may have to include them as well with the contributions that you make to the plan. But if you don't, or if your employees are all 1099 contractors, you can make, again, much larger contributions on an annual basis. And the SEP IRAs work just like traditional IRAs. There are tax deductions for your contributions, and ultimately the money comes out. You get tax money when you pull it out in retirement. The other accounts, the Solo K, the QRP plan, and people have different names for it, but it basically is a 401k plan for you, again, as an owner-only business that, again, allows for much larger contribution limits. You can borrow money from the plan. You can put both Roth and traditional funds into the same plan. The drawbacks, though, of this type of plan, I want to make sure I cover this, is that you do have to have a valid business. Now, it doesn't have to be your primary business. If you're self-employed and that is your primary source of income, then you absolutely qualify for a Solo K. If you work for a company though, and you have a consulting business on the side, that consulting business could have its own solo 401k as well. But you do have to have a valid business, whether it's your primary business or a side business, in order to have that solo 401k account. But we're going to circle back to this plan a little bit later when we talk about some of the rules involved with IRA investing. But essentially, self-employed individuals, the SEP or the solo K, talk to your CPA about it, get more information about those types of accounts. You can see the differences between the accounts on this slide as far as an annual basis of contributions. Traditional and Roths, you're limited to $6,500 a year. With a SEP, you're up towards $66,000, and the similar figure for the solo 401k plan. There's kind of different formulas on how you get there. I really won't bore you with those details, but you can obviously see the huge difference between a SEP, solo 401k versus your traditional and Roth IRAs as far as contributions go. Kind of bump through that slide there, but using an IRA versus solo K is a question we get quite often. Again, IRAs are easy to establish. The IRA custodian takes care of all the reporting for you. Anyone can have one. Solo 401ks, though, you have much higher contribution limit. And the one thing we're going to talk about is something called UBIT tax. I don't know if you want me to get into that, Whitney, a little bit when it comes to the syndications, but UBIT is an kind of, I wouldn't say unknown, people certainly are aware of it, but it's a little known tax that can actually apply to IRA accounts where they're invested in debt financed real estate investments. That UBIT tax obviously can affect your overall return, but solo 401ks don't pay that tax at all. So that's one of the advantages really that they have over the IRA accounts. So when it comes to these accounts, again, going back to whether you have a traditional, a Roth, SEP, there are even simple IRAs out there, not a lot of those around, but those are other types of accounts, or you have those old 401ks. Now you have that money in a Schwab account or Fidelity account, and you want to use it to invest in real estate. One of the first questions we get asked is, how do I get that money moved into a position where I can put it into a real estate investment? And you move money between IRAs and 401ks in one of two ways, either by doing a transfer, which is moving money from IRA to IRA, or by doing what's called a direct rollover. That's moving money from like an old 401k or an old 403b type plan over into an IRA account. So it's just really different naming conventions, and it's a little bit different process. And that's something obviously we help you manage when you're getting an account set up. And hey, is your money in an IRA? Then we need to do a transfer where we will submit the paperwork to your other custodian to get that money moved. If your money happens to be in that old employer's plan, it'll be a direct rollover, and you will need to initiate that on your end. But either way you move money, whether it's transfer or rollover, as long as the funds never touch your hands, it's going directly from one institution to the other, it is a non-taxable event to you. So you can move money as often as you'd like between IRAs or between an old 401k and an IRA account. There's no restriction as long as the money doesn't touch your hands. And again, it's not going to be taxable to you. That is something that I've had CPAs, I've had financial advisors even not fully understand at times, or people go to people might go to their brokerage firm and say, hey, I'd like to invest in real estate. I need to move this money to an account that I can do. And they're told that, if you want to invest in real estate with your IRA, you have to take a distribution and pay tax on it, and then use the money accordingly. What those custodians are not realizing is that you could set up a self-directed IRA to make those investments in real estate, keep the investment underneath your IRA umbrella. And when you move the money, it is going via a transfer or a direct rollover. And so you are not taxed on that money. So I'd like to reiterate that a couple of times, because people will get different advice from their CPA, from their brokerage firm. When you say, hey, I'm using this money to invest in real estate, they most of the time do not see the self-directed component, where you're actually not taking this money out personally. You're just choosing a different type of IRA custodian that is going to allow you to replace your mutual fund, replace your stock investments with real estate and other types of alternative assets. Just a little bit on the rules. I don't like to spend too much time on the rules because there's only a few things really that are restrictive within the IRA environment. And when you look really outside of what the rules are, there's so much more you can do, and things and ways you can place your funds into different types of investments. When it comes to investing within retirement accounts, the IRS says there are two types of investments you cannot make inside your IRA. You cannot buy life insurance, and you cannot buy collectibles like antiques and artwork. Those are the only two prohibited investments. So, Advanta can't hold those, Fidelity can't hold those, Schwab can't hold those. Those are prohibited under the IRS guidelines. The other restriction that comes much more into play with self-directed accounts is the prohibited transactions and the disqualified persons, where the IRS does not allow your retirement account, which the IRS views as a separate legal entity from yourself. They do not allow that retirement account to transact or invest in a way that a disqualified person may get a benefit from the investment. The disqualified persons for your IRA are yourself, your spouse, your children, parents, grandchildren, grandparents, are all the disqualified persons for your retirement account. In simple terms, you can't buy a property inside your IRA and want to use it personally or rent it to one of those disqualified persons. If you own one of those assets personally, you cannot sell it to your IRA. So if you own real estate as an individual, cannot sell it to your IRA account. Cannot lend money from your IRA to one of those individuals as well. So there's some restrictions when it comes to dealing with the disqualified persons. But if you're looking at truly investing with other people, whether it's a syndication, whether it's buying a rental property, whether it's lending money to a third party, as long as no disqualified person is getting a benefit or is on the other side of that transaction, then there's really no restriction on doing it. Again, no life insurance, no collectibles, and what we call no self-dealing or dealing with disqualified persons. So when you look again outside, I'm not sure how many people on this call have invested in syndications, starting their own syndications, looking for different types of investments like that. There are so many different avenues you can go down with investments, and staying completely clear of these particular rules. So they're not really that limiting in nature at all when you're looking at third parties. The other area, I mentioned earlier, is the UBIT or UDFI tax. Again, it's a little known tax. It can apply when your IRA invests into a business entity, or if your IRA is investing into real estate where there is underlying debt. Again, this is a tax that applies to IRA accounts. It does not apply to solo 401k plans when they're investing in leveraged real estate assets. So just a little bit on the rules there. I wanted to touch base, and we'll kind of get into some other examples and kind of what the process looks like with investments. I'm not sure if we had any other questions. Again, if you have any questions as we go along, definitely get those in there, and we'll make sure we get those answered. As far as passive investing, obviously we're on the passive investing masterclass. A couple different ways you can do that. I mean, there's certainly the multifamily properties, or people who buy single family rentals, the syndications, doing notes and mortgages, joint venturing, startup companies, land, things like that, where it's really much more of a passive investment activity. One of the questions we get asked from time to time is, if I was syndicating a property, can my IRA invest? And we really shy away from telling people you can do that. That's to us, it's a violation of the rules where you personally are now involved and being active. The IRA really is, and the 401ks are really more passive investment vehicles that the IRS. That's the way they look at those investments. So any of the investments on this particular slide would fall in line with that, where you're placing your money into an investment and sitting back, and then either taking in the cash flow, cashing out at some point to get the profits or appreciation from your particular investment. So I wanted to go through a couple of case studies really to illustrate kind of how the process works. We've talked already about the types of accounts that you can establish and use to self-direct. We've talked about the method of moving that money, either via a transfer or via a direct rollover, again, which is tax-free movement of money either way. Then the last component for clients is now, how do I have this money? I've opened the self-directed IRA. I've done a transfer. I've done a direct rollover. The cash is in the account. Now, how do I actually deploy that money into an investment? And what is that paperwork and what does that process look like? So our first case study.
Before you launch
Sure.
into this, I mean,
Sure.
this is something that I really, am passionate that people understand, because when they start getting into a self-directed environment, one, it's kind of a double-edged sword. You've been in the stocks, bonds, and mutual fund world, but you're not happy with the lack of control and the returns. You want greater control, diversification. So you move your retirement funds into passive, or excuse me, a self-directed environment. That thereby you are now in control, but you need to be prepared to take that control by understanding your goals, your risk tolerance, your timeline, all these things that, you know, Scott has said, the work you need to do before you actually go into a deal. But also there's more paperwork, and you're in charge of the paperwork on this. But really, you know, there's a ton of systems in place to help make this as smooth as possible. So for those of you who are starting to see this case study and you're like, eyes are glazing over going, I don't know if I'd ever do this. You have to understand this paperwork gets done regardless. It's just now it's you doing the paperwork with your custodian because you've chosen to take on that control and put this investment closer into your control in your hands. So I just wanted to kind of help people orient their mindset around this if they haven't already thought about that.
Oh, that's a great point, Whitney. Yeah, when it gets the investment side, to be honest, a lot of the times when people started evaluating the self-directed IRA as an option, they may have already been presented with an investment opportunity. So I have a slide here towards the end. It talks about the 3 steps, and step 3 is start your investing. And for a lot of people, that's step 1, right? They've come across an investment opportunity, and they've started to do their due diligence, and they've started to evaluate, hey, how am I going to make this deal happen? And that's when they either get introduced to the concept, or they start looking around at how could I use my IRA in this particular deal, and they kind of come at it kind of back that way. But I think you make a great point. If you are looking to self-direct and say, hey, I'm not happy with where my funds are currently as far as the investment options, I'm in a brokerage account, I'm in a bank CD, I want to do something different. You know, step 1 is deciding, hey, that's not going to be for me, and I want to take more control. But step 2 is going to be then deciding, if I'm not going to do those investments, how am I going to move that money? What types of investments am I going to place these funds into? Sitting in cash in an IRA is not a good strategy in the long term. There's, I mean, certainly people do it short term to take, you know, they're still scared of the markets here and there. But overall, you need to have that IRA producing a return, and it's really how you're going to do it. So we get into talk about these case studies here. I mean, these are examples of things that people have done. And there is, like as Whitney said, a lot of paperwork and a lot of background information that the investor has to do. You have to do your due diligence. You have to evaluate different investments. You need to talk to different people and ask all those questions, because one of the things that we don't do as a self-directed administrator is we do not sell investments, and we cannot give you investment advice. If you said, hey, self-direction sounds great, I'm tired of the stock market, here's my money, Advanta, put it to work for me, we can't do that. And no self-directed company is going to be able to do that. It's going to be up to that point for you to tell us ultimately what it is that you want to invest in. And when you do that, we will walk you through the paperwork and walk you through the process of how you do it. So I think that's a great point, Whitney. So in our first case study, we have Jane, who's the one with the cash, has money in an IRA account at Vanguard. John has an offering. So he's looking to purchase and remodel an apartment complex, looking for different investors, kind of a classic syndication type model. You can see in the case notes here in the case study, John provides Jane with the prospectus, with the subscription documents. Here is my business plan. Here's what I'm looking to acquire. Here are the different returns I'm going to pay. Here's how the profits are going to be shared among the different investors. And that is up to Jane to review those documents and be comfortable that she wants to make this investment. And any questions that she has, make sure John answers those. She needs to get a tax advisor or a different investment advisor in to help her evaluate it. That's really going to be, again, up to her. Our role is going to be simply when Jane says, hey, I want to invest in John's subscription in this private placement, we're going to make sure that the right steps happen for her to get these accounts open. So in this particular case study, Jane is able to open up a solo 401k. She had a side business and she's self-employed. So she's able to move that $100,000 into a solo 401k plan. We help her get that money transferred from Vanguard over from the IRA again to her solo K. Money doesn't touch her hands. Again, a non-taxable movement of funds, and we will let her know when those particular funds arrive into her account. So the next step, though, while we were waiting for the transfer of funds, or maybe if the funds have arrived already, Jane is going to need to provide us with that subscription document. And we are going to want to make sure, one of our primary roles at Advanta is to make sure that these investment documents properly reflect her solo 401k as the investor in this particular syndication. So it's not Jane Smith individually investing. It is Jane Smith as trustee of her 401k plan. If she were to fill out these documents personally, using her social security number and all of her information as an individual, and then pull money out of her IRA or pull money out of her 401k to make the investment, the IRS will deem that to be a distribution from her account that she is now liable and subject to tax on. By making sure that the investment is titled properly in the name of the IRA or in the name of the 401k, that shows the IRS that this is a retirement plan asset. So when the cash leaves her account to make that purchase, it is not taxable to her. And even better, all of the gains that accrue and come back from this particular investment are returning to her IRA or returning to her 401k plan, not to her. So all of the gains are reported back to the IRA, back to the 401k plan, not to Jane, not to her social. So that means all of the gain as well is going to come back into her account. So this is a way to grow your retirement account. You look at the documents, Jane's going to sign the subscription documents. We wire the money out of the account. And then going forward, those quarterly distributions each year come back to her IRA account. If John refinances the property and cashes out all the investors, or if he sells the property, Jane's 401k is going to get its share of the overall returns as well. All of that money coming back into her IRA or into her 401k. One thing I like to always make sure to mention, because this is, again, a question I get asked occasionally, but again, if you're looking at using your IRA and your 401k funds to make an investment, whether it's a syndication, whether it's a rental property we're going to talk about in just a moment, the income does go back to the IRA. It is not a situation where you make the investment with your IRA account, but then all of the dividends and all the profits go back to you. So I know some people have asked me that in the past. I want to use my IRA to create cash flow now for me. And the IRA and the 401k doesn't work that way. The cash flow, the gains all have to go back into the IRA. And then from there, if you want to take a distribution, you can, subject to any taxes or any penalties or such. But this is, self-direction is a way to grow your retirement accounts. If you have money in an IRA, you have money in an old 401k, the ideal goal is to just grow that money as quickly and as high as possible before you start pulling that money out in retirement age. It's not a matter of using this money to also benefit you currently. So I want to just make sure I make that point, because I do get asked that question every now and then. All the gains are going to accrue to the IRA itself.
And I think we can go through this part pretty quickly, because we do have several questions stacking up, and I want to make sure we leave time to get to those. But I think, I think it's worthwhile to go through like the single family real estate, because so many people, investors that we work with, actually have their old landlords, right? Or they also want to have controlled real estate in addition to their passive investments. But yeah, I'll let you touch on this really fast.
No problem. I'll go through it quickly. So yeah, the case study is really just an individual having money in his IRA or his old 401k, wanting to buy real estate. Again, the difference in this process versus the previous example is we're going to be going through closing documents for real estate. So anyone who's ever bought a piece of real estate, there's a contract and there's a closing statement, there's a deed, there's a title settlement, etc. All of those documents, like in the last example, the subscription documents needed to reflect the IRA or the 401k as the owner. Same thing here. The property is going to be purchased in the name of Advanta for benefit of John Smith's IRA account, and the funds are going to come from the purchase. So again, our role is going to be to make sure that all the documents show the IRA account as the actual owner. And before we sign any documents or send any money, we make sure that, in this case, John reviews and approves the entire set of documents. He's going to initial off on the contract and ultimately on all the closing documents as well. So in this case, he's making the purchase just from his IRA. So that means all of the income that's generated comes back to his account. Any expense related to this property gets paid by the IRA as well. And that's something, again, in Advanta we do. We will receive the rents and income, And at John's direction, we will cut checks out of his account to make those investment payments as well. The one kind of little bullet point in the middle there, the other thing to note, if you're ever looking at making an investment and you don't have enough in your IRA, specifically, it is possible to partner your IRA account, say in a spouse's IRA or somebody else's personal funds, and make the investments and have your IRA have a kind of a partnership type agreement or a partnership ownership, part ownership in a particular piece of real estate. Then you would just split the income and expenses. And we've seen a number of instances where, say, husband and wife each put in cash towards a deal, whether it's a syndication or whether it's a single family property, and you just share the income and expenses according to that proportion. So it is possible to do that type of what we call partnering arrangement with your IRA account. Again, in this case, the IRA receives the rents back in the account. It pays the bills. Any profits on the sale, again, all coming back to the IRA account. So in this case, there's no leverage. There's no UBIT. He paid cash for this property. Using his IRA, he's just got more money to use going forward. So again, your IRA invests, all of the income generated goes back to the IRA, whether that's cash flow or profits on a sale. Any expense related to that investment gets paid out of your IRA, and your net obviously is the return going back into your account. And I think, what type of an investor are you? Obviously we're on a passive investing masterclass, and we're talking about passive investing. Some of you though may do some active investing here and there. And if you're looking at being a more active investor on the IRA side, that might be, rehabs or auctions or wholesaling deals where you do have more control. And then you're a decision maker and you're hands-on. Downside is that's probably taking up a lot of your time, maybe some of your expenses as well. And ultimately you are responsible. And then kind of contrasting that with someone who is more passive, where you're not putting in as much time. You're not bothered by the daily minutia and going on, with that particular investment. But you're gonna maybe have less control over the management. Either way, I'm talking about control here, be active and passive. That's really more for this particular investment. But I know that we talked about the start of the presentation today is really, are you in control of your retirement? And so control really to us when it comes to self-direction is deciding what type of an investment as a whole I wish to make. Again, whether it's real estate, startup companies, precious metals, there's so many different things you can do. And again, a lot of our clients do go towards the real estate aspect of the investments. And then once you're choosing in real estate, you have just so many different options. If you decide, hey, I want to be a real estate investor, what is that going to look like? And so I include this slide really to kind of just illustrate what some of those different investments might be, and the pros and cons of both. There are some people who do not like to relinquish control and would want to be in charge of a rental or a rehab property. Other people say, hey, you know what? I know enough to get into to evaluate a potential deal, but I don't want to be bothered by all the day-to-day activities. I'll put my money with somebody else. I trust them, and I'll earn a nice return back on my funds. But again, control in this particular instance is really just over this particular investment. But in the larger context, having control over your retirement funds is really, again, about choosing the investments that you wish, as opposed to only choosing from that menu selection that we talked about at the very beginning, where you're giving a list of investment options and that's it. And most people don't realize that they could throw away that menu and simply find a completely new one where they make up and actually put what's on the menu for their particular retirement account and what they choose to invest in. I mentioned it's really easy to start. I mentioned a minute ago, step 3 is where a lot of people start. They actually have the investment in mind. I have a friend of mine who's starting up a syndication or needs a loan for a piece of real estate, and I want to use my IRA. So they have step 3 done. They've already found the investment. They come back to us to get the account set up and get that account funded. So it's not a very long process. I think usually for someone to make an investment, you're looking anywhere from probably 10 days to 2 weeks, and the large waiting period on that time, a large chunk of that time is waiting on getting money transferred or rolled over from your other custodian. Again, we walk you through each step of this process to make sure you don't have any inadvertent tax consequences or make any missteps in getting that money moved over. And then we do all the administration of that account going forward and holding the investment, making sure it's titled properly, and then doing the IRS report and it goes along with it. So Um, that point is kind of, I guess, my end of my prepared remarks, and I'm happy to certainly take questions here. And I'll add to this that what I did today was really a truncated version. There's so many different ways and avenues you can go down when you talk about self-directed IRAs. So people who have questions, either ask them now, or you had my information, I can put it up again in a minute. Reach out to me and let me know, because there's a lot more that we could get into that I want to give just a really good overview today.
Yeah. Well, Scott, again, thank you so much for your time, knowledge, and expertise. For those of you who are joining live, don't go anywhere. We're going to do a Q&A session afterwards, starting right now. For those of you who are listening on your favorite podcast player of choice or watching this on YouTube, Scott, go ahead and mention where they can find you.
Yeah, here's my information right here. There's my email address. There's my phone number. You can go to our website at advantaira.com. We have a good YouTube list. Go to our YouTube page, a good laundry list of webinars that we've done in the past on a lot of different topics too. But if you have a specific question, I find the best way to get it answered, just call me or shoot me an email and we'll get to your direct problem or direct issue.
Awesome. Well, again, Scott, thank you for joining us today. If you're here live, don't go anywhere.